We're going to finish our looking into Chapter 11 and foreign subsidiaries by looking at Problem 9. Problem 9 is a remeasurement using the same basic facts as Problem 8, so it will be a good comparison between the two to see how remeasurement and translation differ, which is a big subject on the CPA exam. Basic concept behind remeasurement is that we're looking as though currency we're translating into was the one that was used all along. It means that, in essence, that currency was the functional currency as described in the book, and therefore any adjustments related to the differences between the two currencies is part of ongoing business right now and therefore becomes part of net income, unlike the translation adjustment, which we saw just continues to grow and accumulate and go into OCI. So you'll see we have the same basic subsidiary trial balance here to start with, and we need to go ahead remeasurement each of these items. So cash and receivable are going to be using the same rate because those are items that are current. They don't have a historical value. The difference here comes in when we have something that is more historical in nature, because then we want to go back to reflect the actual transaction and what happened. So you'll see the first one is inventory, which we're going to calculate in our schedules down below. And you'll notice that this is historical because there's different periods when we have acquired the inventory under LIFO. And again, if you go back to the text and look for the information, you'll see that prior to our acquiring it on July 1st, 2015, there was 1.5 million in foreign currency for inventory. And this is given in your text. That historical rate at the date that we acquired it, as we saw in problem 8, was 55. So the remeasured amount for our beginning inventory is $825,000. We also, though, have another layer of inventory that again is given there in the text of 6.5 million. This relates to, it says, the first quarter of 2017. So if we go to the first quarter average, again given in the text, we'll see that the 62 rate is the applicable rate. That is how we get our remeasured amount. So the total remeasured for inventory is 4,855,000, which we then go ahead and put into our trial balance. Depreciable assets are also going to be a historical item. So we're going to go down below for that and its related depreciation to again do the calculations here. Again, going back to the textbook, we see that at our acquisition date, which is how far back we go because that's the starting point, if you will, for this economic entity and group, there was 30 million in foreign currency, which remeasured at the historical rate gives us 16.5 million. Then there were also some assets that were acquired on April 1st, 2017. So if we go to the text, we see that the historical rate for April 1st, the date of this acquisition of assets, gives us a rate of 64, and therefore our remeasured assets are 2,560,000, the sum being 19,060,000, which then again goes up into our table. Now the accumulated depreciation relates directly to that because if you think about it, we depreciate the items with a direct correlation to when they were acquired. So we're going to go ahead and just copy that information, the 30 million and the 4, and we're going to use actually the same rates. But the difference here is that we have to obviously take it as depreciation. For our 4 million, we take the remeasured amount at the 10-year straight line rate, but we had it 9/12 of this year, so that gives us 192,000, and therefore our total accumulated depreciation becomes 6,792,000, and that's what we carry up to our trial balance. So hopefully you're starting to see very similar here, but we have to apply different rates based on when it happened because under remeasurement we're looking to capture the actuality of what occurred. Now for this year's expense, we take the same consideration Same factors that we used for the actual asset and the accumulated, but now we want 1 year's worth of depreciation. So we're going to take our remeasured amount and 1/10, and for our asset acquired this year it's going to be the same thing because there's nothing accumulated from prior periods, and therefore our expense for the current period is $1,842,000, and we're going to bring that up to our trial balance as well. Then we're back to a related party, due to, due from, which is current, doesn't have historical, so we're going to do that at the current spot. Same with other current liabilities. So those two are back similar to translation. So you'll see there are 4 items that are done at the same rate. Common stock we saw is historical based on when we acquired it at July 1st, 2015. So we put those in. Then we're down to retained earnings. And we know from our problem 8 that retained earnings has a layered impact because that's the nature of retained earnings, to be the balance carried forward plus income less dividends. Well, the starting balance in retained earnings was the $2,520,000, and that's at our historical rate again. Then we're going to add in our incomes. Now these are given in the book for problem 9. So we don't need to recalculate them. We can go ahead and enter them because that was what was actually factored into the parent's investment account as well. So our total retained earnings for the beginning of the year, because remember we haven't closed out current year income, is $4,856,000. Now we are down to our sales factor. Sales we're going to do just like we did with translation at our average rate. Cost of sales, however, we cannot, because cost of sales relates to inventory. Inventory was done at a historical rate, therefore the corresponding expense also needs to be done at historical. So our first layer is the $23,400,000 for purchases over the 9 months of 2017 that were sold. The applicable rate as given in the text is 66. So that's our first layer. And then we also have the $4.2 million that was from the first quarter, and that applicable rate to give us a total of $2.6 million in dollars, and a total cost of sales then of $18 million. And that will go up again to our trial balance. So now we have just a couple of items left. That interest that we saw was at the end of the year. Since it's at the end of the year, we can use that rate. Exchange gain we're going to assume was based on the average, and other expenses we're going to do based on the average rate, assuming that they occurred equitably throughout the year. So you'll see here we don't have as large of difference because we're recognizing this into income every year. So it gets closed to retained earnings, it's incorporated into the numbers, therefore it's not this cumulative amount for all historical amounts that has to be accumulated in OCI. We take care of it directly. So here we're going to record the remeasurement loss for the current year of $297,000. And then we are ready to go back to the worksheet. Worksheet's going to be very similar to what we did before. Couple of minor differences you'll notice in the trial balance, starting balances of Balfour. Because under remeasurement, instead of accumulating those differences in OCI, it becomes an integral part of income and retained earnings and investment. There's a few differences in your starting balances. But when we come down here to the bottom, you're going to see a lot of our entries are very similar. If you notice right away though, you'll notice our D and our A entry do not have that cumulative translation adjustment for the same reason I just talked about. There is no cumulative translation adjustment because we're recognizing everything right away in the current period. So to eliminate our current subsidiary income, we go right to the trial balance and pick up that amount that's in the parent's trial balance. Our EL entry, we go back to the trial balance and look directly at the subsidiary's equity accounts and eliminate that against the investment just like we did before. And for the equipment, we're going to take it at the historical amount because that's what we use at remeasurement, and therefore there's no translation adjustment. For our depreciation, again, there's no translation adjustment because we're recognizing everything as we go. And our L1 and our L2 entries are identical to what we did in problem 8. They're just eliminating that intercompany activity. So that should look very similar and should give you a direct comparison. I'll go ahead and pause this, put the numbers in the worksheet like I did on problem 8, and then we'll come back and look at the final product. Okay, after we have carried our entries to the worksheet and posted them like we would in a general ledger, we go ahead and carry our balance sheet amounts over to the balance sheet. Again, remember this one does not have NCI, so it's fairly straightforward. We do have to make a couple of adjustments like we did before because not all of the adjustments fit on a single line. For the investment account is one, and for retained earnings, which has an additional line. Then our income statement items, we go ahead and carry across to the income statement. And you'll notice that I did pick up the remeasurement loss because remember that is part of net income under the remeasurement method. You'll notice our interest income and expense were eliminated. We've incorporated the other items and we have total consolidated income of 19 million, which would be closed to retained earnings, and therefore our balance sheet would balance and we would be ready to prepare our final consolidated financial statements. So hopefully these two will give you a good comparison between the two methods.